It's obviously quite volatile today. You can see we broke 132 again. Now, the market clearly wants there to be a Conservative majority. The polls are narrowing, which suggests that we may not get that when the actual results come out in our time tomorrow in Asia. I suspect, though, that for the time being, people will hold on to their sterling for the next 24 hours. As the polls come out, if they do suggest that Boris Johnson is going to get a majority, then I think we'll still see a decent rally in sterling. So we'll probably go from 132 up to maybe 135, 136 over the next week or so.
But is the sterling looking toppish in and around these levels? So as much as 135 to 136 is as good as it gets on the sterling. Nancy was making the point that, you know, it's not like when the Tories win, it gets into this blue sky territory or re-rating zone where it tests pre-2016 referendum levels of 150.
So that's where I disagree, actually. Maybe we can get sterling re-rated. The reason is that if you get a majority now in Parliament, and so the Conservative government passes the withdrawal agreement bill, then you take away that risk of a no-deal exit at the end of January. Now, we think that the only main players in the markets at the moment are hedge funds, so short-term players. The medium-term real money managers and the longer-term central banks have been very sidelined on sterling for the last few years. But once they have some clarity, finally, on the UK's exit from the EU, if it's an orderly exit, they'll come back in. They feel that sterling is actually still very cheap.
So near term to 1.35, but over the longer term, that can adjust.
Yes, and that actually that re-rating could occur actually quite rapidly. It could be that we could be above 140 in Q1 as soon as we get through that exit.
The trouble is, Mansoor, I mean, how much clarity will we have just with the withdrawal? Because it's really the negotiating period that takes place after that with the EU that's going to determine what that trading relationship looks like.
So that negotiating period could take a very long period of time. I think what has sidelined these medium-term and longer-term money managers has been this risk of a no-deal exit. And that risk will initially, anyway, be taken off the table at the end of January if the UK passes this withdrawal agreement bill. So that reduction in risk, I think, would bring investors back into sterling. As you say, later on in 2020, you still have the risk of an exit again at the end of that year if there's no free trade agreement and no extension of what we call the transition period. So July the 1st is actually a key date to see whether the the transition period gets extended. We think it probably will be, and that'll then reduce longer-term risk. But in the very short term, what's interesting is that there is a clear demand for sterling. That demand, we think, will kick in again. So even 135, 136, near-term probably isn't the high, assuming we get an orderly exit.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.